Assalamualaikum warahmatullahi wabarakatuh. Thank you for the opportunity. We are from Group 5 and we'd like to explain about the chapter 16, which is the general ledger and reporting system. Well, before we move to our explanation about this material today, I'd like to introduce you to our group members. So first is me, Lazwardi Imani, with student number 047. And next is Fitri Nurkolisa with student number 257. And next is Unifarida Aprialinda with student number 281. And the last is Bertalia Permata Putri with student number 440. So without any further ado, let's get started. Okay, let's move to our material. So the first is the introduction for this material. And actually, this chapter or this material discuss about the information about the processing operation involved in updating the general ledger and preparing reports that summarize the results of an organization's activities. So as you can see in the figure 16.1, the general ledger and reporting system plays a central role in a company's accounting information system. Its primary function is to collect and organize data from the following sources. The first is each of the accounting cycle subsystems described through 15 provided information about regular transaction. So you can see about the every cycle that happen in a company like the production cycle, the revenue cycle, the expenditure cycle, and so far and so on. And it is described through 15 provides information about the regular transaction. So the regular transaction we can see from the arrow, the blue arrow that uh, going through the middle about the picture, which is the general ledger and reporting system. So it means that the general ledger and reporting system plays a central role because from every cycle that happen in a company is the transaction will go straight to the general ledger and reporting system. And the second is the treasurer provides information about financing and investing activities such as the issuance or retirement of debt and equity instrument and the purchase or sale of investment securities. And the next is the budget department provides budget number. Of course, that the budget department is like they forecasting or probably they make um, budget for that the business that will apply for a period like that. And then the last is the controller provides adjusting entries. Yes, we know that the controller is they control about every cycle that happen in a company, so they provide adjusting entries. It means like in the end of the period, we need to adjust uh, some kind of the transaction and some kind of the account that happen in the company for a period like that. Well, next is you can see the picture or the figure 16.2, which is shows the basic activities performed in the general ledger and reporting cycle. So the first three activities represent the basic steps in the accounting cycle, which culminate in the production of the traditional set of financial statements. So you can see that the first until three is like the usual process from the transaction until the financial statement. So the first is update general ledger. So of course it's like the treasurer input the transaction or the journal entry according to the transaction that has done by the company and also uh, from the accounting subsystem. And next is by post adjusting entries and it is done by the controller. So as I said to you before, that the controller will provide the adjusting entries at the end of the period because we know that the company should adjust some kind of transaction and some kind of account that need to be um, adjusted and in the end of the period, like the depreciation, or probably like the usage of the um, usage of the subsidiaries and so far and so on. And next, after posting the journal entries, we prepare the financial statements like the um, profit and loss statement, and probably the changes equity for the owners, and also the um, financial position for the company. And also, after the three activities represent the basic steps in the accounting cycle, the fourth activity indicates that in addition to financial reports for external users, an organization's accounting systems produces a variety of reports for internal management. So of course they need to prepare the management report or managerial report for themselves because it is will relate with their performance during the year. So for each activity, we can describe that how the information needed to perform and manage the activity is collected, processed, and stored. We also explain the controls necessary to ensure not only the reliability of the information but also the safeguarding of the organization's resources. In addition, we discuss the impact of regulatory and technological changes, such as the proposed switch from GAAP to IFRS and the SEC's mandate to use XBRL for electronic filing on the design and operation of the general ledger and operating systems. We also explore how tools such as responsibility accounting, balanced scorecard, and well-designed graphs can improve the quality of information provided to managers. Next, we enter about the main material for today, which is the general ledger and reporting system. So the first, we will discuss about the process. So the centralized database must be organized in a manner that facilitates meeting the varied information needs of both internal and external users. So managers need timely detailed information about the results of operations in their particular area of responsibility. So investors and creditors want periodic financial statements and timely updates to help them assess the organization's performance. Various government agencies also mandate specific information requirements. To satisfy these multiple needs, the general ledger and reporting systems not only produces periodic reports but also supports online inquiries. Next is about the threats and controls. So of course, for the general ledgers and also the reporting system, and furthermore, it needs to have the online inquiries because there are lots of users, both internal and also the external. Of course, it has the threats and the company need to control this. So the inaccurate general ledger data can result in misleading reports that cause managers to make erroneous decisions. Of course, if there is an inaccurate data about it, so the financial statement will have a wrong information and it will mislead the decision makers to make the decisions for the company. And similarly, errors in financial statements provided to creditors, investors, and government agencies can cause those stakeholders to make wrong decisions. So it will have a huge impact if they have an inaccurate data about it, because the information provided and also the data provided will be used both for internal users and also for external users. So in addition, errors in financial statements and reports provided to external stakeholders can also result in fines and negative reactions from the capital market. So the threats will be uh, there will be lots of threats from the activities that happen in the company. So for the general issues throughout entire general ledger and reporting cycle, so it's from the general activities from the general ledger itself. The threat can be the inaccurate or invalid general ledger data, unauthorized disclosure of financial statements, and loss or destruction of the data. And also, when we update our general ledger, the threat can be inaccurate updating of general ledger and unauthorized journal entry. And when we post adjusting entries, there will be an inaccurate adjusting entries and unauthorized adjusting entries. And when we prepare financial statement, there will be an inaccurate financial statement and fraudulent financial reporting. And when we produce managerial reports, there will be poorly designed report and graph. So for each activities that happen in company that I've explained before, they will have lots of threats, and company needs to control this. So they have to make a really great control system to control threats that might be not happen yet, but uh, it won't happen. It will happen. I mean, it will happen, and they need to have a control system that prevent those kind of things. So that's all from me, and next explanation will be delivered by my friend. Thank you.
Okay, thank you for the opportunity. My name is Fitrin Kholisa, my study number is 257, and now I will explain about update general ledger. There are several points in the update general ledger, but first I want to explain the process. In the process, the originate from two sources. First is accounting subsystem and the second is treasurer. So first is, in theory, the general ledger could be updated for each individual transaction. In practice, however, the various accounting subsystems usually update the general ledger by means of summary journal entries that represent the result of all transactions that occur during a given period of a time, each by day, week, or month. For example, the revenue cycle subsystem will generate a summary journal entry debiting account receivable and cash, and crediting sales for all sales made during the update period. Similarly, the expenditure cycle will generate summary journal entries to record the purchase of supplies and inventories and to record cash disbursement in payment for those purchases. And the second is treasurer. So the treasurer office provides information for journal entries to update the general ledger for non-routine transactions such as the issuance or retirement of debt, the purchase or sale of investment securities, or the acquisition of treasury stock. Except by two sources that I explained before, there is the journal voucher file. So the journal voucher file contains the information that would be found in the general journal in a manual accounting system. The date of the journal entry, the account debited and credited, and the amounts. Okay, so next I will explain about the threats and control. There are two sources that have been explained before about journal entries for updating the general ledger. First is summary journal entries from the other AIS cycles and direct entries made by the treasurer. So the former or themselves are the output of a series of processing steps. each of which was subject to a variety of application control procedures designed to ensure accuracy and completeness as described in the preceding 4 chapters. Consequently, the primary input edit control for summary journal entries from the author cycle is configuring the system to verify that the entries represent activity for the most recent time period. Journal entries made by the treasurer are originally data entry. Consequently, the following types of input edit and processing controls are needed to ensure that they are accurate and complete. So now I will explain about the kind of such thing to check the accurate and complete. So first is a validity check is have a goal that to ensure that general ledger accounts exist for each account number reference in a journal entry. Second is field or format checks to ensure that the amount filled in the journal entry contain only numeric data. So if that in the data is not only a numeric, that will be error in our data. So next is a zero balance check to verify the total debits equal to credits in a journal entry. This is the basic explanation about the accounting that the asset and the debit and the credit must be or should be equal. So fourth, there is a completeness test to ensure that all pertinent data are entered, especially the source of the journal entry. The fifth, closed loop verification, matching account numbers with account description to ensure that the correct general ledger account is being accessed. And the sixth is a sign check of the general ledger account balance once updating is completed to verify that the balance is of the appropriate nature or debit or credit. So the last but not least is calculating run-to-run totals to verify the accuracy of journal voucher batch processing. So there are the step and not step, I'm sorry, there are the kind of point that will be checked the accuracy and completeness in general ledger. Okay, next I will explain about the reconciliation and control reports. So the reconciliation and control reports can detect whether any errors were made during the process of updating the general ledger. So one form of reconciliation is the preparation of the trial balance. The trial balance is a report that lists the balances of all for all general ledgers account. We already know that we have been learned this before about the reconciliation and trial balance. So trial balance is the way that we use to check there are the debits and the credits was equal, and if they are not equal, there is something wrong that we already made, like we know that this is called human error. Maybe we are wrong to place the account in the wrong place, or we forgot to return the transaction, like that. So another important reconciliation is comparing the general ledger control account balances to the total balance in the corresponding subsidiary ledger, that like I've been explained before. For example, the sum of the balances of individual customer accounts should equal the amount of the accounts receivable control account in the general ledger. If these two totals do not agree, the difference must be investigated and corrected. So we know that maybe if we are doing wrong, like human error, it must and it should be investigated and be corrected for to know that there are where is the correction about the wrong written. We are already written. At the end of a fiscal period, it is also important to verify that any temporary or suspense or clearing accounts have zero balances. So we already know in the general ledger, in the end of the in bahasa it's called laporan, there is mention about the zero point. So the zero it means that the debits and credits was equal and there is something wrong to the equal of they are, but we already know that we must and we should to check that again. There is maybe something we are already uh, written the account in the wrong place like that. So I already written in the slide of PowerPoint. There is first journal and the second journal. So the first journal is in the debit unbilled shipment and the credit inventory. So in the finish of, or maybe we already to check, there is the second journal. So the second journal or the finished journal is the cost of goods sold in the debit and account receivable in the debit, and the credit is unbilled shipment and sales. Thank you, and the next explanation will be presented by my partner.
Thank you so much for the opportunity. My name is Junia Pralanda and my student number is 281. And now I'd like to move on to this slide that leads us to the next point of the trade and control of general ledger, which is the audit trail. So the audit trail is a traceable path that shows how a transaction flows through the information system that affect general ledger account balances. And a properly designed audit trail provides the ability to perform, first, trace any transaction from its original source document, whether paper or electronic, to the journal entry that update the general ledger, and to any report or other document using that data. And this provides a means to verify that all authorized transactions were recorded. And second, trace any item appearing in the report back through the general ledger to its original source document, whether paper or electronic, and this provides a means to verify that all recorded transactions were indeed authorized and that they were recorded correctly. Okay, so in this slide, I'm going to explain about the process, threats, and controls of post-adjusting entries. So adjusting entries originate from the controller's office after the initial trial balance has been prepared. Adjusting entries fall into 5 basic categories. First is accruals, second is deferrals, estimates, revaluations, and last is corrections. So the first is accruals. Accruals are entries made at the end of the period of the accounting period to reflect events that have been occurred but for which cash has not yet been received or disbursed. Second is deferrals. Deferrals are entries made at the end of the accounting period to reflect the exchange of a cash prior to performance of the related event. So the third is estimates. Estimates are entries that reflect a portion of expenses expected to occur over a number of accounting periods. Fourth is revaluations. So the revaluations are entries made to reflect either differences between the actual and recorded value of an asset or a change in accounting principle. So the last is corrections. Corrections are entries made to counteract the effect of error found in the general ledger. Then we can see the threats and controls of post-adjusting entries. So inaccurate and unauthorized adjusting journal entries are threats that need to be addressed because they can produce erroneous financial statements that lead to the poor decisions. So strong access controls can reduce the risk of unauthorized adjusting entries. In addition to the preceding preventive controls, periodic reconciliations and audit trails provide a means to detect unauthorized or inaccurate adjusting entries. Okay, so next I'm going to talk about the prepared financial statements. So, most organizations close the books to produce financial statements monthly, quarterly, and annually. We now discuss two important recent regulatory and technological developments that are likely to significantly affect the process of preparing financial statements. First, we have the proposed upcoming change from USGAAP to IFRS, and second, we have the mandatory use of XBRL to submit reports to the SEC. So, the first is the proposed upcoming change from USGAAP to IFRS. Although the effective date continues to be pushed back, the SEC maintains that it is committed to requiring American companies to switch from US-based GAAP to IFRS as the basis for preparing financial statements. Companies need to begin planning for the transition now because it will likely require extensive changes to their general ledger and reporting system. There are several differences between GAAP and IFRS. First is one major difference concerns accounting for fixed assets. Under GAAP, most major fixed assets are recorded and depreciated on a composite basis. In contrast, IFRS generally requires compensations of fixed assets to recognize the fact and that different elements may have different economic lives. Another difference involves accounting for research and development or R&D costs. IFRS permits capitalizations of development costs at an earlier stage of the process than does GAAP. A third difference is that IFRS does not permit use the last in first out or LIFO method of accounting for inventory. So the next is the mandatory of use XBRL to submit reports to the SEC. So XBRL stands for Extensible Business Reporting Language. It is a programming language designed specifically to facilitate the communications of business information. The SEC requires US public companies to use XBRL when submitting their filings. To understand the revolutionary nature of XBRL, examine figure 16.8 in this slide. So you can see the picture of this slide. This is a figure of 16.8, which is the revolutionary nature of XBRL. So the top portions shows that prior to XBRL, preparers had to manually create reports in various formats for different uses. Although those reports were then sent electronically to users, the recipients then had to re-enter the data into their own system in order to manipulate it. The entire process was inefficient and prone to errors. So you can see the bottom portion of figure 16.8. It shows how XBRL improves the whole reporting process. Preparers encode the data and transmit it electronically in various formats to users. We can directly analyze it. Thus, XBRL saves time and reduces the change for data entry errors. Without XBRL, electronic documents, regardless of formats such as text, HTML, PDF, and etc., were essentially just digital version of paper reports. Humans could read the data, but computers could not automatically process it until the recipient manually entered in the appropriate format. XBRL changed that by encoding information about what a particular data item means so that other computers program can understand what to do with it. Okay, so that's all from me. The next slide will be presented by my friend. Thank you.
Thanks for the opportunity. Here I'm Berta. I will continue the explanation of the presentation. So in this slide, we can see there are 5 basic attributes to define each element. The first is a unique identifying name, that is a name that's used by the software, and the second is a description, that is that can be used to correctly interpret the element. And the third is the element has a type, that is such as a monetary unit, text, or date. or etc. And the 4 is the element normal balance type, such as a debit or a credit, like that. And the last is the element period type. So if it's in a one point in time, it's called instant. And or if it's a period of time, it's called a duration, like that. And the next is taxonomy. So what is taxonomy? Taxonomy itself is a set of files that called link bases that can define the relationship among the elements in a specific instance document. So here there are 5 important link bases. The first is a reference link bases that identify the relevant authoritative pronouncement. And the second is the calculation link bases. The calculation link bases is is bases that specify how to combine element. And the third is definition link bases that indicates the hierarchical relationship between among the elements. And the fourth is the presentation link bases that describe how to group the elements. And the last is the label of link bases that associate the human readable label with the elements. And the next is the accountant rule. So there are 4 accountant rules here. The first thing is that accountants play a major role. So here the accountant should play a major role in all phases of producing the XBRL report, begin with the selection of an appropriate taxonomy. And the second is to select the standard taxonomy. So the accountant should use to uh, their knowledge of the organization business strategy, organization business practice, and the general accounting principle to select the best standard taxonomy that fits with the organization itself, like that. And the third is creating style sheets. So accountants usually typically participate in creating style sheets to ensure that the information is displayed appropriately. And the last is use software to apply taxonomy. So usually like accountants likely to use the any software or any extension to apply the taxonomy to tag the organization data or create the instance document, then validate it to those instance documents before they're submitted, like that. And the next is the threat and the control. So the first threat here is the creation of inaccurate financial statements. So this risk is actually highly happen. But to control this threat, we can use the data processing integrity control for the journal entries, which combined with the use of packaged software. It can help to produce the financial statement that minimize the risk of a numerical error in a data, like that. And the second threat here is a risk that financial statements may not accurately represent the result of operations. So, because both of IFRS and XBRL require a numerous judgment about how to classify the information, this risk is highly happen. In that case, therefore, the best control is training and experience, because experience is likely reduce this risk to happen, like that, to make such this mistake happen, like that. And the last risk here is fraudulent financial. So fraudulent financial itself is another potential problem, because it's difficult to prevent such an internal control. Therefore, the best control to mitigate this threat is by having an independent review audit. And slide, the next slide is about the managerial report. There are two sections here. The first is the process, and the second is the threat and the control. So the process of produce the managerial report itself is using the ERP system, where in the ERP system can produce a number of structures that can help the manager to plan and to evaluate the performance. An operating budget describes the plan with revenue and expenditure for each organizational unit. And the ERP system also displays the data in a graph visually so that the manager can quickly identify the important trends and relationships as well as the area in needed or more detailed analysis. And one important thing in the process is also that the accountant should understand how to use the flexible reporting and graphing capabilities of ERP system so they can added a value by suggesting alternative ways to organize and analyze the data about the business process. And here, the threat and the control is only one, that is a poorly designed report and paragraph, because uh, it can cause the manager to make a bias, make a bias when the manager make a decision making. Then, in order to control the threat, there are three controls. The first is to use the responsibility accounting and the flexible budget to design a performance report. And the second is using the balance score. And the last but not least is understanding the principle of proper graphic design. These three controls will help to mitigate that risk. And it will be explained more detail in the next slide by my friend. That's all from me. Thank you.
All right, ladies and gentlemen, so the next material we will discuss about the responsibility accounting and flexible budgeting. So, to properly evaluate performance, reports should highlight the result that can be directly controlled by the person or unit being evaluated. So responsibility accounting does this by producing a set of correlated reports that break down the organization's overall performance by the specific subunits which can most directly control those activities. So we have to understand that how each report shows actual cost and variances from budget for the current month and the year to date, but only for those items that the manager of the subunit controls. Also, we have to understand about the hierarchical nature of the report. So the total cost of each individual subunit is displayed in a single line item on the next higher level report. So it is also important to design the budget so that its content matches with nature of the unit being evaluated. So for example, that the performance report that focus on cost. So because the production departments are usually treated as cost centers, in contrast, sales departments are often evaluated as revenue centers. Consequently, their performance report should compare actual to forecasted sales, broken down by appropriate product and geographic categories. So similarly, reports for departments that are treated as profit centers should include both revenue and expenses. So we move to the flexible budget. So a flexible budget in which the budgeted amounts vary in relation in some measure of organizational activity, so mitigates such problems. And in terms of our previous examples, so Flexible budgeting would entail dividing the budget for each line item in the general superintendent's department into its fixed and variable cost components. So in this way, budget standards will be automatically adjusted for any unplanned increase or decrease in production. Thus, any differences between these adjusted standards and actual cost can more appropriately be interpreted. And next, we would like to discuss about the balance scorecard. So, one problem with the reports produced by many accounting systems is that the reports too narrowly focus on just one dimension of performance that's reflected in the financial statements. Balance scorecard attempt to solve that problem. So, the balance scorecard is a report that provides a multi-dimensional perspective of organizational performance. So, a balance scorecard contains measures reflecting for perspective of the organization, um, including the financial, the customers, the internal operations and innovation, and also the learning. The financial section contains lagging indicators of past performance, whereas the other three sections provide leading indicators about likely future financial performance. And for each dimension, the balanced scorecard shows the organization's goal and specific measures of that reflect performance in attaining those goals. Together, the four dimensions of the balanced scorecard provide a much more comprehensive overview of organizational performance than that provided by measures alone. So next we will discuss about the principle of proper graph design. So well-designed graph make it easy to identify and understand about the trends and relationships. Poorly designed graph, however, can impair decision making by misdirecting attention, hiding important changes in the data, or causing erroneous initial impressions. However, graphs not only must be easy to read but also must lead to accurate interpretations of the underlying data. So the following two principles are essential for properly designing bar charts of financial data so that they are accurately interpreted. So the first is begin the vertical axis at zero. So doing so ensures that the depicted magnitude of change in the data accurately reflects the actual change in the data. So beginning at a value other than zero, by contrast, distorts the visual magnitude of a trend. To see the importance of this rule, compare figure 16.12, which follows this principle, to figure 16.13, which does not. Notice how figure 16.13, the growth in EPS appears more dramatic than in the figure 16.12 because the height of the bar for $2.87 is about 7 times as tall as the bar for $1.25, even though EPS has only slightly more than doubled. And the second is for graph that depict time series data. Order the x-axis chronologically from left to right. So this principle is illustrated in figure 16.12 and 16.13. Violating these principles may cause the viewer to form an erroneous initial impression of the nature of the change in the data. So well everyone, thank you for the attention, and before we end our presentation, we'd like to apologize if there are some words or there are some explanation that's not clear for you, or probably lots of us just saying wrong words and wrong terms and wrong interpretation probably, and so far and so on. So we would like to apologize about that, and thank you so much for the time and also paying attention for our explanation. And the last we say, wassalamualaikum warahmatullahi wabarakatuh. Thank you.